He kōna ipurangi tēnei nā te reo irirangi o Aotearoa.
Welcome to No Stupid Questions with Susan Edmunds. We're back, and I want to thank everyone for all the feedback we received from our first episode. Thank you for all the emails and even voice memos that came in. Please keep them coming. No Stupid Questions is the podcast that wants to answer all your money questions, whether they're things you've always wanted to know but haven't known who to ask, or things you were worried sounded a bit silly. Don't worry, I've got lots of those myself. We'll tackle anything that's related to money, how you spend it, save it, invest it, make it. I'm joined today by Justin Gregory.
Hello, I barely make it, I barely invest it, I hardly save it, but I can spend it.
Well, it's good to have a strength.
Shall we get into it?
Shall we get into it? Yeah. Yes, let's go.
All right, our first question is from Andrew, who asks, I've noticed that most Kiwisaver providers seem to restrict you to having all your money in just one fund type, example aggressive, balanced, conservative. But Sharesies has recently announced a Kiwisaver offering that allows investors to choose a mix of different funds, and even a proportion that can be directly invested in specific listed companies. Why do most providers have this restriction that members can only have their Kiwisaver funds in one fund type? And is this likely to change to give people more choice as they approach retirement? Now, Andrew also notes that capitalism is based on the assumption of infinite growth. And he says, as developed economies grapple with declining birth rates and we reach the limits of what resources we can efficiently, practically and sustainably extract from the earth, what does this mean for the future of capitalism? Is there a way economies can continue to grow without more people consuming more stuff?
So these are quite large questions. So let's step them through one by one. First, it's not the case that you're always restricted from having money in more than one fund type. I used to have some of my Kiwisaver split across balanced and growth funds before I went all in on the growth. But I do know that some do have that restriction. So if yours is restricting you and you don't want that, you can always move to a different provider who will let you. I talked to Dean Anderson, who is the founder of Kernel Wealth, to help me with the rest of this question. He says with advances in technology, more Kiwisaver providers are now enabling members to split their savings across different funds to suit their preferences, as I said. But he says for many investors, a single diversified fund is still the simplest and most common choice. But if you're buying a first home or preparing for retirement, the option to divide your Kiwisaver into separate buckets with different risk profiles can be really valuable. So, if you're coming up to 65 and you want to have some of your money that you're going to spend right now and some you're going to leave invested for 20 years, you might have a few different fund types going on. And as for adding specific investments in companies or particular assets, as Andrew notes that you can do through Sharesies, Kernel also lets its members add funds that invest solely in things like the S&P 500. But whether you should do that is another question, I reckon. Something I personally always think is that there's patchy data at best about whether fund managers with all their time and resources can outperform the market with their stock picks. And I'm not sure that as an individual I would be able to do much better. So that's why I always think, do I really want to be getting into that with my Kiwisaver? But if you're really keen on it, a particular investment, maybe you've got, they call it high conviction, don't they? So you've got high conviction about a certain company you want to invest in. There are an increasing number of ways that you can do that through your Kiwisaver. I reckon the ideal, though, might be to keep your Kiwisaver really basic and then do your dabbling in other investments on top of that outside the scheme, provided you have enough money to do that. And as for the capitalism question, which is probably something that deserves its whole entire podcast devoted to it, you're right that it relies on people consuming more over time. I talked to Dean about that too, and he agrees that the future of growth will probably have to look different as population growth slows and traditional resources are finite. He points out that increasingly economic value is shifting away from purely physical consumption and towards services, experiences and what he calls intangibles like education, health, digital innovation and intellectual property. And that allows prosperity to expand without the same footprint. He says there are reasons for optimism. The rapid rise of renewable energy, particularly in places like China, shows that we can transition away from resource-heavy growth models and towards ones that are more sustainable. So if we get this right, he says the future can be both more productive and more resilient.
So that's a positive response.
Yeah, I think there's something quite positive about investing in general, because I think you wouldn't do it if you don't think there was a chance that the future could bring more opportunities and just better stuff than we've got now.
I know we've got a bit more Kiwisaver to chat about a bit later on, and Lord knows we're going to talk about Kiwisaver a lot in this series, but we'll hop on to our next question right now. It comes from Margaret, and she asks, recently on financial news reports, we hear about surveys of retailers feeling positive. And at the same time, the news is that retail transactions and spending are down, and retailers are stressed. So why bother to survey feelings, and what is the explanation for this contradiction?
Yes, sometimes it seems like we have a lot of vibes and reckons. Do we really want to be surveying to get more of them? But to answer this question, I went to talk to Simplicity chief economist Shamabil Yaqub, who himself is a great purveyor of reckons.
It's important to understand how people are feeling because it's a necessary but not sufficient condition of if people will act. So what I mean by that is when we're feeling optimistic and we have money in a bank account, we're likely to spend. The same is true for businesses. When they're feeling optimistic and their customers are coming through, they're more likely to hire people and invest. So that can be a really good leading indicator of where the economies are going. But like I said right at the beginning, it's a necessary but not sufficient condition. We have to look at confidence with other indicators at the same time.
Okay, because we assess sentiment in lots of different areas, don't we? We have like business sentiment and consumer and inflation expectations and all that sort of thing.
Absolutely, because expectations can drive behavior. It gives you a sense of what people are thinking, but then you have to corroborate that with what people are doing in terms of actions. So, for example, when I look at business confidence, I don't look at it alone. I look at what businesses are saying in terms of the optimism and compare that to with what they're doing with, for example, job ads. So, if you're very optimistic and you're not advertising vacancies, then probably your confidence is more hopeful than real.
True.
Okay. Sorry if there was a little cough in that audio. School holidays, so I have a helper. The idea is that we can get a sense of what might be coming down the line if we know how people are feeling. So the difference at the moment between what people are saying and what they're experiencing is probably that they are looking forward to what might be coming ahead rather than what's happening to them right now. I know with inflation, for example, we talk about expectations quite a lot because they can drive people's requests for pay rises and that sort of thing. So what they think is going to happen can become self-fulfilling.
Our next question comes from Jessica. She's in Wellington, and she wants to know about valuing possessions. Go ahead, Jessica.
Susan, my mum is broke, but she is surrounded by stuff like art, old jewellery, some old furniture, and it might be valuable, but I don't know. How do I find out if something's valuable, and when is it worth paying someone to do a valuation? Thank you.
So I started to look into this a little bit recently when I wrote about the price of gold. At that point, I discovered that more people are selling their secondhand jewellery via the auction houses at the moment because the price of gold has gone up a lot and it's boosting what you can get paid for it. So the auction houses told me that there's particular demand for well-known brands. If it's stuff that you can carry, you can usually pretty easily go into an auction house to have it appraised. If you have a lot of things that need valuing, you can have a valuer come on site to your house or your parents' house, or you can work with one that offers valuations online. A quick Google shows me that there are a few that offer this service around the country. There are also organisations that handle cleaning out houses, particularly for people going into retirement homes, and they say they can guide you on decisions about what is worth selling on Trade Me, what could go to an auction, and what could be donated. One I checked out wasn't taking a commission on what was sold and said they were just going to charge an hourly rate. So that could be just a way to get some expert opinion and help through that process.
Now, if you were Jessica, would you try to sell the stuff yourself, or would you get someone to help?
I think it depends on the item and also how much time and energy you have to put into the sales process. Because people think it's straightforward to chuck stuff on Trade Me or put it on Marketplace and sell it. But you often need a fair bit of admin time to make it happen well. You need to be available to answer questions. You need to take good photos, write a good blurb. For higher value stuff, I can definitely see the merits in getting help from the experts.
And we're back to Kiwisaver again. You had a question in your written Q&A over the weekend, Susan. That was about how tax applies to the Kiwisaver scheme.
Yeah, someone wanted clarification about how capital gains are taxed in Kiwisaver and tax in the scheme more generally.
All right, so how does it work? Go on.
With Kiwisaver, we have what is known in retirement savings circles, such a thing does exist, as a TTE scheme. So contributions are made from your taxed income, that's the first T. The returns are taxed, that's the second T. But when you withdraw your money, it's exempt from tax, which is the E. It's different from other countries where you might be given some tax incentives to contribute, or you might get a tax break on your returns, that sort of thing. But then you pay tax when you exit the scheme. So if we had tax breaks on returns, for example, we could have much larger saving balances at retirement because the impact would compound over time. But maybe that's an argument for another day. But with regards to capital gains tax, the answer is basically that there isn't tax on capital gains that your investment makes. If you have New Zealand shares in your investment, you'll be taxed on the dividends you get from that company, but not the increase in the share value generally. Where it gets slightly murkier is with the foreign investment rules, because you're taxed based on a percentage of the value of your investment each year. So you could argue that's taxing capital gains, although it's not really the intention. But in general, no tax on capital gains. And I'm sure we're going to talk about that a little bit as we get closer to the election. You can see the tax you've paid in your annual statement.
Okay, so that brings us to the end of our second episode.
Last week we asked whether you think the amount of cash in circulation is going up or down, and the answer is...
It's neither.
Yes, sorry, this turned out to be a bit of a trick question because although the amount has increased a lot in recent years, particularly going into the pandemic, between 2024 and 25 it barely moved at all. But in general, the trend has been for the amount to increase a lot, from just under $5 billion in 2015 to $8.6 billion last year and $8.59 billion this year. So the Reserve Bank was expecting the big increase in 2020 to be unwound, but that hasn't really happened. Cash in the hands of the public went from $6.28 billion in 2019 to $7.3 in 2020. That's the bank notes in public possession measure.
Right, got all that? Excellent. Okay, so now our question for this week is, how much money do you need to have to start a bank?
It's an interesting side hustle, but I don't judge. Send your answers to questions@rnz.co.nz. We also want all your questions, so please keep them coming. Even if you think they're a bit weird or niche or silly, send them over. If we can't answer them ourselves, we will find someone who can.
Or we'll be off running our own bank. That's us for this week, and we'll talk to you next time.
We'll have more of your questions and answers next week. Bye for now.
No Stupid Questions with Susan Edmunds was written and presented by Susan Edmunds. Justin Gregory is the producer. The engineer is Elliot Childs. Thanks to Andrew, Margaret and Jessica, that's me, for the questions, and Dean Anderson and Shamavil Jacob for their answers. Follow and listen to No Stupid Questions with Susan Edmunds on Apple Podcasts, Spotify or any podcast app so you don't miss an episode.